Hi, I'm Bill Kralke at Third Eye Analytics. Our catchphrase is clarity over complexity. We specialize in making it easy to understand what is driving your business. We make business analysis fast and intuitive. For demonstration purposes, I'm going to look at the P&L statement. We'll analyze its changes in gross profit margin. We'll see how easy it is to determine the largest factors. Then we'll just do the same thing, looking at changes in professional fees. And once again, see what was driving the change. Now this demo is a little long, so remember, you can always click on the gear icon to watch it at 1.25 or 1.5 speed. So here is the Third Eye P&L for fast analysis. It's your basic P&L statement. Amounts for a current period, prior period, dollar difference, percentage difference versus the prior year. Now for this analysis, we're going to focus on the percentage of sales for the current period, prior period, and the difference. Now, one of the most important metrics for a business is gross profit margin. In this example, we can see the gross margin increased 3.5 percentage points from the prior year's 28.51% to this year's 31.6%. So this is a strong improvement, but the question is why? To answer the why, we drill down into the cost of sales. We see 4 subcategories: material, labor, overhead, and occupancy costs. Now to answer the question, why did margins improve? We just look on the right for the largest bars. We see that overhead decreased 5.2 points, and that was offset by a 2.1 point increase in materials. So the answer is gross profit margin improved because of a decrease in manufacturing overhead costs. So that's the quick answer, but once again, we are hit with the next question. Well, why did manufacturing overhead decrease 5.2 points? To answer that, we just drill down into the overhead category. Once again, we see all the subcategories. Looking over at the right, we can visually see the largest decline was freight recovery at 3.3 points of gross margin. We see the next largest decline was general insurance, down 1.2 points. So now we know the biggest factors for improvement in gross margin was the decrease in manufacturing overhead, which was primarily freight recovery, and to a lesser extent, general insurance. Now I'll quickly show how easy it is to drill down even further, investigating professional fees. If we look into overhead expenses, corporate, we see professional fees decreased $11,000. Once again, the question is why? We can guess, but it's better to drill in and get the hard numbers. All we do is we right-click, select Drill Through, and go to Account Analysis. Here we see the expenses for the period compared to the prior year by individual vendor. This is sorted by the largest difference, this year versus prior year, and we can clearly see the decline was due to the reduced payments to Dewey Cheatham. If we needed to, we could drill a little further. Click on Lean Manufacturing Consultants, and I see the individual transactions this year versus prior year. We even see the batch numbers. If AP got sophisticated, then we could put more detail info into the voucher or reference columns. If needed, these tables could also be exported to Excel. Hopefully you can see how fast variance analysis can be using the Third Eye approach. This speed of analysis enables a much deeper understanding of what is driving the financials. The best thing, it is tied to the numbers. It's not just speculation. With solid analysis, you can make better business decisions. At Third Eye, we believe in clarity over complexity. If the complexity of your chart of accounts is preventing you from seeing the business trends clearly, then reach out to Third Eye Analytics. We can typically put together a custom analytical dashboard like this in 2 weeks.